Good afternoon and welcome to BizTech's Asian Midday Market Watch, powered by Austral Asset Management out of Singapore. It's Thursday, the 19th of January, and we have our regular Thursday guest, David Kuo, founder of the Smart Investor Singapore. David, good afternoon.
Hi, good afternoon. Selamat tengah hari to you, Brian.
Now, Selamat Tengah Hari, I'm going to come back to you, David, and get your insights. But before that, let's take a look and see how the numbers stack up across the region in the first half of the trading day. We start with the crypto markets. Bitcoin is at 20,818. It's down 2.14%. Ethereum is at 1,529. It's down 3.46%. Now, looking across the regional stock markets, we've got the SGX, where you're at. It's down 0.39%. Bursa Malaysia is up 0.07%. Shanghai is up 0.16%. The ASX All Ordinaries is up 0.53%. The Nikkei Buxton Trend is down 1.49%. The Hang Seng is up 0.07%. And rounding up the numbers, we've got the Kospi, which is up 0.21%. David, your thoughts on market performance in the first half of the day?
Well, I would say that was pretty resilient considering what happened over in America last night. I mean, it was shocking. The Dow Jones was down about 600 points, and so too was the S&P and the NASDAQ. Yeah, so all three indices in America were not looking particularly bright. And so for Asian markets to be slightly up, if not just treading water, I would say was pretty resilient.
Now, what spooked markets, David?
Well, what spooked the market was US retail sales. I mean, that fell more than expected by about 1.1%. And we also saw that manufacturing was down. So what we're seeing over in America is the first signs of recession. Dare we say the R word? I mean, we could possibly be seeing a downturn in the US economy, which shouldn't be entirely surprising either, given the way that interest rates are going up and inflation is still relatively high. So people just haven't got the ability to go out and spend money like they did just after the reopening after the pandemic. So I think that there are definitely signs at the moment that the US economy is slowing. And we also have some verbal signs from some of the Fed governors who are saying that they're still going to carry on increasing interest rates. Whether those interest rate increases are going to be 0.25% or a 0.5 percentage point, interest rates are still going to go up in the US. So I think it's a case of, if you are in the retail trade, if you are looking at the US economy, it's certainly time to batten down the hatches. And one other thing, Brian, and that is the job losses that were announced by Microsoft and Amazon. I mean, 10,000 jobs going at Microsoft, which is about 5% of his workforce, when originally he said it would only lose about 1% of his workforce, and then 16,000 jobs going at Amazon. So somebody's battening down the hatches over there.
And obviously, are those really then the signs of there's continued carnage in the tech sector?
Well, I should think so. I think probably during the pandemic and maybe shortly after the pandemic, there was a great deal of hiring going on by these companies. They thought that, what happened in the past is going to carry on in the future, and that people are going to be working from home, and that we'll be embracing technology in a big way. But maybe the reality is setting in that they just hired far too many people. I mean, in the case of Amazon, maybe, people aren't just going to be shopping online anymore. If people are returning to work, then do we really need that many people working in warehouses? And I think there is probably a sea change going on. But more to the point, I think these companies, both Amazon and Microsoft, have been around a long time, long enough to know what it was like when the dot-com bubble burst. And they don't want to be caught in the middle of the crossfires this time between an economic downturn and raising interest rates. And they probably know that the Fed is not going to come to their rescue anymore. So they might as well just bite the bullet now, reduce their headcount somewhat, and try and reduce costs so that they can survive and emerge probably sort of stronger companies after the economic downturn.
Now, and as you've alluded to, again, these are old tech companies. They've been through many cycles. This is not the newfangled tech companies that just gone listed recently. So they've got plenty of cash in the balance sheet. They've seen these movies play out many times before. So as you pointed out, they're just making sure they're preserving their earnings as well, moving forward, and perhaps putting all the bad news up front, so that, as Microsoft already alluded to, even as they've done the 10,000 cuts, we're going to be hiring selectively moving forward. Now, David, I want to swing now to Singapore and Malaysia, because Goldman Sachs recommends shorting the Singapore dollar. What are your thoughts on this, and why is this the case?
Well, what they're saying is that the Singapore dollar was a safe haven, certainly during and after the pandemic. And it was understandable why a lot of people decided to park their money in the Sing dollar. As a result of that, many of the regional currencies suffered. And also the US dollar. I mean, the Sing dollar appreciated quite significantly against the US dollar. So a lot of people were parking the money here in Singapore, seeing it as a safe haven currency. But maybe it was overdone slightly. And also at the same time, the Monetary Authority of Singapore uses currencies as a way of controlling inflation. So what they realize is that they import a lot of goods from outside. So when the Sing dollar is stronger, it means that import prices are likely to be moderated somehow. And that would in some way insulate, if not protect, the Singapore consumer. But it doesn't seem to be happening. I mean, inflation is still running at about 6.5% at the moment. And so what I worry about here is that if there is a two-way pull between the world at large trying to short the Singapore dollar, and at the same time, the Monetary Authority of Singapore trying to appreciate the Singapore dollar by buying the Singapore dollar and selling other currencies, who is going to win? I have no idea who is going to win, this particular battle. But Goldman Sachs is saying that maybe investors or speculators should start looking at other regional currencies. And one of the ones they particularly like, believe it or not, Brian, is the Malaysian ringgit. And they're saying that, maybe it's time now to have a look at the Malaysian ringgit. And so what they're suggesting is sell the Singapore dollar and buy the Malaysian ringgit.
Now, on the Malaysian ringgit, Bank Negara is due for a interest rate decision shortly. There's market talk of a small 25 basis point increase and perhaps one more. What are your thoughts on it?
Well, we're going to have to wait until 3 o'clock to find out what Bank Negara finally decides to do. I think out of all the analysts that were surveyed, there was one analyst who said that maybe the Bank Negara would not increase interest rates. But all the others are saying that, as you quite rightly said, a 25% increase. But the question is that still going to be enough? I mean, if you increase the interest rates from 2.75 to 3%, when inflation is running at 4%, then I don't think it is nearly done yet, especially if we believe that interest rates need to be above the rate of inflation in order to control inflation. And here in Singapore, I mean, interest rates are running at about 3%. Inflation rate is running at 6%. So anybody who's out there putting their money into things like bonds and savings accounts are effectively losing the buying power of the money that they have saved. And so it really is a very difficult decision. But as far as Malaysia is concerned, if you increase interest rates too much, is it going to drive down the economic growth of Malaysia, which is another problem altogether? I mean, only recently, your new prime minister was saying that national debt is running at 1.5 trillion Malaysian ringgit. And it is about 80% of economic output for 1 year. So debt to GDP in Malaysia is running at 80%, Brian. I mean,
and that's a near historical high or at historical highs?
It is definitely at or near an historical high. Well, whether you say it was higher than this time last month or the month before, I mean, $1.5 trillion Malaysian ringgits worth of debt is an awful lot of debt to be carrying. And so how is Malaysia going to grow? So that goes back to the question of Goldman Sachs saying, oh, short the Singapore dollar, buy the Malaysian ringgit. The question is why? Why would you want to do that if the economy of Malaysia is not going to grow. And I look at Malaysia and I just think, where is the economic growth going to come from? Certainly not from consumer spending, because consumers don't really have that ability to go out and spend money anymore. Private sector investments. Well, you already have a labor shortage problem. So why would foreign investors or existing companies in Malaysia want to invest in Malaysia when they can't get the workers? And then you have net exports. And if the global economy is going to weaken, where is the exports going to come from? If you can't even get the workers to work on the farms to go and harvest the goods that you have, what are you going to be exporting? And then, of course, finally, you have government spending. And I think Anwar Ibrahim has already said, forget about building monuments out there because, well, where is the money from the government going to come from? Is it going to borrow money to go and build another Petronas tower somewhere? I think the answer is no. So I think we are in a very, very difficult situation, not only in Malaysia, but I would say everywhere else in the world. And it's a case of every man for himself at the moment, Brian. And as far as I'm concerned, I'm carrying on investing.
Now, David, as always, thanks for your insights. Thanks for coming on the show.
You're welcome.
Now, we've been speaking to David Kuo, founder of the Smart Investor out of Singapore, on BizTech's Asian Midday Market Watch, powered by Austral Asset Management Singapore. I'm Brian Fernandez. This interview will be on our website, www.biztech.asia, as well as our social media platforms. It'll also be on our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.